All right, Mr. Patrick Francie, Alex Bell of MyCore Insurance. This is a good conversation, even though insurance isn't sexy and it's not fun. I tell you, when you can't get insurance, you get, you have my attention real quick. And Patrick, there's a lot of stuff going on right now in the insurance business.
It has been, and it's been leading up to this over the past really couple of years. But a conversation around insurance is both timely and incredibly important, given what we're dealing with these days as real estate investors. And so it's great to have Alex join us and get some of these questions answered.
Awesome. Alex, welcome, my friend. MyCore Insurance, give us a quick kind of overview, Alex, on you and MyCore, just to set the context, and then let's jump right into the challenges of what's happening in the insurance business right now.
Yeah, absolutely. It's great to be with you guys again. Thank you for having me. So MyCore, we are a national brokerage. We just opened some offices out in Calgary, and we're soon to be opening one in Edmonton. We're a niche shop. Unlike a lot of brokerages, what we would call generalists, at MyCore, what we do is we specialize in certain sectors. So I'm the vice president of the realty practice for MyCore, and I'm very, very niche, and unlike most generalists. So about 6-7 years ago, I'm also a real estate investor. I think I've told you that in the past, JG. And I was looking for trying to find quality insurance for my portfolio, and I saw an opportunity to create this program. And so the last 6-7 years, this is what I focus building my practice on. This is all I do. I don't do any other type of insurance. So whatever the solution would be, there's all, as obviously you guys teach all RAIN members, whatever the strategy or the deal, whatever it is, I have access to insurance markets and solutions that would handle, that would actually mitigate the risk for those types of projects.
Perfect. Well, that's great. So what kind of challenges are you seeing, Alex, right now in the insurance business? Like Patrick said, it's been kind of cultivating over the last couple of years, building to kind of, for some, a crescendo of problems.
It is. And as I've said in the past, and I'll say it again, so I'm an insurance broker. I don't work for one particular company. We're in what's called the hard market right now. And it looks like we've been in it for 2 years now, and from what I'm reading and what I'm hearing within the industry, it's going to be like this for another 3-4 years. When I say hard market, I am very honest about the insurance industry. The insurance company, they're always complaining that they're not making money. That's not necessarily true. What it is they're not making as much money as they projected and what they have in the past, right? And another portion of that is the investment income. So that's how a lot of insurance companies make profits, right? So for every dollar they take in premium, a certain portion or segment of that is directed into investment income. So because interest rates are so low, they're not getting the historical returns that they used to in the past. So this is why we're in the market. Now, that being said, when it comes to property and casualty insurance, which is exactly what real estate investors need, I will say this, in all candor, there has been a large loss ratio, especially in Western Canada, right? Fort Mac would be an example of that. The insurance industry, all the carriers that were on risk for that did have substantial losses. Subsequently, the insurance companies based on their actuarial losses, they had to increase rates. As I tell every client that I work with, the appetite for this class of business, guys, is very, very limited, right? Insurance companies are no different than oil and gas, big pharma, banks. They're in it to make money, plain and simple. That's what they're in this for. And when they can't make money in, they don't want to play in that space. So that's why for real estate investors, it's hard to find insurance companies that will go on risk.
So you made a couple of, one of the things that you said in that was that, a hard market, probably 3 to 4 years. When it gets out of that hard market, it's because really they start to make some version of money again, and things start to soften up. But when you take let's say an Aviva, I'll just use them as an example. Yeah. Let's talk about Aviva. So we've got high claims in Western Canada, and I'll use Calgary because it's just the most fresh in my mind, where giant hail damage this summer back in, I think, early July or something. That portion of Calgary looks like a war zone because it wiped out houses and cars and everything else. I mean, huge payout. Then you had Fort McMurray flood, after just recovering from Fort McMurray fires. And I'm just picking on them right now. So those are really, really big claims. And then maybe, fires in California. The point is this. Are those things affecting rates nationally right across the board? So something that happened in Alberta, are they paying a premium above Ontario, or does Ontario, for example, absorb some of those costs as well and then experience those increased rates?
Great question, Patrick. So the answer to that, and I'm very familiar with the Aviva model, all right, exactly what you're talking about. So with what's happened with Aviva is that is a division of, right? So that's Aviva special risk, all right? That's specifically you're talking about. Aviva globally is a massive company. So you are exactly right. What will happen is, so Aviva special risk, when they look at their overall portfolio, right, it will cover right across Canada. Now, they tend to separate or segment the Canadian loss ratio from the US base, right? So, but you're exactly right. So all those losses, those large losses they had to absorb out west, they would be pulled in together with whatever portfolio or exposure they have in Ontario, New Brunswick as well. You're absolutely correct. So it's dollars in versus dollar out, simply dollars out, paid out. But particularly for that specific risk pool, it was one loss ratio. Correct.
So what do we do? And JG, I'm not trying to steal the show here, so I just have questions. So what do real estate investors do? Because we got escalating rates, we got, we're considered high risk. I mean, what the hell? We haven't even put in a claim and we're getting hammered. So, what do real estate investors do? How do we work around this? And so what would be some of the tactics you would use? Like, as you said, you're a broker. You're not attached to any given, you're there representing, you're like a mortgage broker in some regards.
Exactly.
Only it's insurance. You're looking for the best deal, the best coverage, the best price, best bang for your buck. So what does a real estate investor do in a case like this, Alex, when we've got all these escalating costs?
Well, you're exactly right. And as I tell everyone, Patrick, so the insurance premium, it's all about positive cash flow, right? It's all about positive cash flow. And if the rates go up, that cuts into the cash flow, right? So fortunately, I don't want to make this about me, but I do have access to insurance companies that have not had those losses, and the premiums are very, very competitive.
And
let's not step over that. Good one, Jim.
Oh, if I could just jump in there, because I think that one of the reasons, Alex, I really wanted us to work together through RAIN is because, I've known Alex for a long time. I've had a lot of insurance with various providers across the country, and Alex's rates are better I'm just giving my personal experiences. The rates are really good, and the coverage is even better. Yeah. And I'm like, how is that possible? It's like that, and that's Patrick. You and I have had the same experience, which is why I called Alex and said, Alex, how the hell are you doing this?
Yeah.
But there's the answer, right? Access to providers that haven't experienced those loss ratios. It sounds like.
And that's truly it, JG. And again, thank you for the kind words. But what it really boils down to, exactly like you said, Patrick, an insurance my job at the end of the day is to go into the insurance marketplace and negotiate, broker the best possible terms. Pricing is one thing, obviously, but a huge component of the clients that I work with, because they have large portfolios, is protecting your assets properly.
Right.
I'll use a term that you that I use all the time, Patrick, that you used on a call a couple months ago. You need to treat this like a business. You need to carve it out separately and treat it like a business. So again, because I niche, this is all I do. I have access to insurance companies that other general brokers would not have access to. Mm-hmm. So that's really it at the end. It's very, very frustrating for investors. Back to a question you posed, Patrick, what an investor needs to do is like when they're when you're filling in a pro forma on a potential deal, you know, insurance, again, I love this, we'll use it. It's not sexy, but it's a big part of it, right? So you need to know, do your due diligence and find out beforehand before you, and I do that all the time with clients when they're looking at a particular deal. I'll let them know what the premium is before they actually pull the trigger on it, right? Whereas I've had some clients call in a scramble, right? They weren't able to actually, not only were the rates high, they couldn't get insurance, right? So the answer to that question is do your due diligence. It's part of the networking experience. Ask people who they work with and different things like that.
What are Alex, what are sort of, can you boil it down to 3 common missteps, 3 common errors, 3 common challenges that investors really need to, you know, like at least get those 3 things handled, and then you'll be better than the average?
Great question, JG. So again, I'll put it under the umbrella. You need to treat this like a business. And the first common pitfall, and I see this with a lot of non-REIN members, I'll say people that haven't spent the money or taken the time to do their homework, their due diligence, learn the systems, is they will insure an investment property if with whoever their personal carrier is, and there's only a couple of companies that would do this. Desjardins is one, TD Insurance. They will insure an investment property if you have your car and your house with them, but they don't insure it properly, right? So they're actually the risks associated, the liability, tenant vandalism, different things like that. So insure it as a business and get the right insurance. Don't insure it personally, right? So you need to carve those 2 out and keep them separate.
Well, let's not step over this point, because I think this is such an important conversation for real estate investors. Is if you're only focused on price, and you're not paying attention to coverage,
right,
and what that represents, when there is an incident, you're going to find yourself looking. All of a sudden, you're going to be reading your policy and going, "Well, what do you mean they don't cover me for X, Y, Z?" Right? Yet the price was awesome. Well, there's a reason the price is awesome, because they've reduced their risk because they're not paying you for X, Y, Z.
Transferring risk, Patrick. That's exactly right. So TD, and I don't mind beating up on TD because they really shouldn't be insuring investment properties, in my opinion. So they're a great bank, fantastic bank, but that's it. And I mean, I tell people all the time, so TD doesn't give you flood insurance, which in my opinion is the most important coverage to have. That's where 70 to 80% of the claims are made right across the Canadian marketplace. So they don't offer flood. They don't offer sewer backup. They don't offer tenant vandalism. And some of their wording is written on what's called the main peril.
It sounds like they're really not offering anything.
They're not offering anything, right? And when I review portfolio, and the other thing as well is appetite. So they'll only insure up to 4 properties, and when you get your 5th, that's it, the risk is too great for them, and then they'll cancel overall. So that and that's it. And what I say to clients all the time is, so my premium will not beat TD's, but I tell them that right before I put the time and the work involved in that. I'll let them know my policy is going to be $200 to $300 more, but is it worth spending $300 to protect an asset that's worth $500,000, right? And I'll pose that question, and if they don't understand that, they don't get it, then it's just simply someone I don't want to work with. I don't have the time to work with them, quite honestly.
So the big lesson there is be price sensitive, but make sure you're comparing apples to apples. Have that list of coverage and know what coverage you need, and then you can start comparing price. If you're comparing coverage to coverage, then what is it going to cost me for that coverage?
Get it right on the head, Patrick. Apples to apples. That's right. For sure.
So what is that? What's another oversight, Alex? The first one is obviously just going with your standard personal insurance, not treating it like a business. What's another oversight?
You know what? I'm just trying to think about that. People not insuring, so underinsuring an asset, right? So there's the coverage piece, but then a lot of clients will underinsure the building, all right, what it needs to be insured for. They just insure it for whatever the mortgage is. The big takeaway that I teach all my clients is the insurance value of a property is always different than the real estate value of a property. They are mutually exclusive. And I'll give you a very, very quick example of that. So You take a student rental in Peterborough, all right, that you paid $400,000 for, okay? It's 2,500 square feet. The insurance value might come out to 500, whatever it is. But if you take that exact same structure, the square footage, the same everything, and you place it down in the beaches in Toronto, you would pay $1.5 million for the property, right? But the square footage, all the variables, the metrics that go into it, the insurance value doesn't change. It stays the same, right? We need to insure it so that that would not really change. So it really is about location, location, location with respect to that. So that's another common mistake I see with a lot of investors. Whoever they were working with didn't insure the building limit properly. They just covered the mortgage, and then that was it.
Can I offer one that's it's an oversight that I see many investors this many years working with investors, and it's an oversight is that when you buy an investment property, you know the date you're going to be taking possession. You need to make sure the day you take possession, it's insured. And some investors, they put it off, or they wait, or they forget. And the next thing you know, they're taking possession of an uninsured property. Puts them at a high risk while they then scramble to get insurance on that property. So, I mean, there's some things to pay attention there too. It's far too common, surprisingly common, actually.
It seems obvious, Patrick, but you're absolutely correct. And then they didn't realize that, and then they need an insurance binder so the bank will release the funds to close the deal. And they're like, "Oh my God, I forgot about that." So I love those ones, especially on a Friday afternoon. Those are the best. But very basic, but yes, that is huge. That's absolutely huge.
Well, what I love, Patrick, Alex, is, Alex, your depth of knowledge in this industry is so deep, and that's why working closely with RAIN members at RAIN member meetings and in the various events. We did that working session, you and I, for an hour. I think it was like 90 minutes of deep diving into statements and deep diving into a whole presentation. That's what RAIN members get, and RAIN members have access to. And I think that, it's really amazing to have someone with your depth of knowledge to be able to support these RAIN members, because as we were talking about, insurance has to be planned out. It cannot be an afterthought. It's such a key part of protecting this multi-million-dollar asset.
That's right.
That you'd be crazy to just throw caution to the wind and whatever comes. So really appreciate your depth of knowledge, Al.
It's my absolute pleasure to be working with you guys. And again, if there are any people on this call who are not RAIN members yet, without a doubt, I've been doing this for 7 years, and it's the absolute best value you can get with any club in Canada. So do your homework and get involved soon. Get involved very soon.
Appreciate that, pal. Thank you.
My pleasure.
Patrick Francie, thank you so much for your time. Alex Bell, thank you so much, gentlemen.